What's up, HyperFast Nation? On this episode of the HyperFast Wealth Show, I am bringing back a previous guest on the show. I talked to this gentleman about a year ago, right before COVID, and on this show, we got an update on how his year went as a real estate investor and developer and where he thinks things are going in this new environment we're in. Welcome back to the show, Marco Santarelli. All right, welcome back to the show, Marco. How are you doing today?
I'm doing great, Dan. It's good to be back on. It's been about a year. It was, I think, right before COVID broke out when we had our last recording.
Yeah, so I was checking the notes before we started here. You were on episode 123, which we published the end of March in 2020, which means we probably did the interview in February. So about a year ago. So you were probably one of the last people that I talked to before COVID and the lockdowns, dramatically changed our landscape.
Yeah, it did. It did. It kind of put everybody into a bit of a free fall for about 3 months. And, people weren't sure if they were going to be out of a job or if their business was going to be affected or shut down. And, the media playing up the pandemic as something that in most people's lifetimes they've never seen. So the question was, what's going to happen over the next coming weeks, months, and even maybe a couple of years? And I know that we, for about a period of 2 months, had a bunch of investors cancel contracts that they were in escrow for to purchase investment property. I'm sure you saw the same thing. Fortunately, it was short-lived. I mean, it came back after about 2 months or 3 months where people were saying, hey, the sky's not falling. Let's just get back to business as usual. But it was an interesting time because we've never seen anything like that, nor have you, nor has probably anybody listening to your show right now. And, well, we're living through it. It's a year later, and I mean, it's been bad for a lot of people. But you and I both, said it just before you started recording that for a lot of people who own businesses that are service-based, other than restaurants and hair care, it's actually been a pretty good year. So.
Yeah, it's been interesting to see who's been impacted, who's not, and some people are having their best year ever. Some people are not. There's this definitely this bifurcation depending on what you do and how big you are. I think that's definitely at play. We've got our hands on the retail side with our brokerage and the investor side with the projects we're doing, and we didn't see much change on the retail side. Like people in the Washington D.C. market still buying homes, and you had to change how you marketed them, how you showed them, how you met with the clients, that kind of thing. Saw more changes on the investor front, especially in the beginning. Like, different types of investors were just kind of hoarding cash or pulling their money for a while, or banks were getting tighter. But even that kind of, was short-lived, maybe 30, 60 days. And then it was almost back to normal, just a different type of normal, I guess. But what's give our listeners and viewers out there today an update. What's been going on the last year for you, and how has COVID impacted you, and what are the biggest lessons you've learned from it?
Well, investors, like specifically real estate investors, they've not pulled back. They took a break for about a couple of months, like I was saying before, after COVID broke out, because the news was just playing it up and there was all these unknowns. But people came back like in droves to buy real estate, invest in real estate, mostly residential, but even the commercial space has been very busy, with the exception of retail, of course. But what's very interesting is we had a problem before COVID, and it was tight supply and strong demand. Interest rates continued to drop, driving more demand because people were coming out of the woodwork to buy and invest in real estate, whether it be commercial or residential. So interest rates were dropping, affordability was increasing, people were coming out, and an interesting problem happened in the fall last year, or no, in the spring last year. The investors who were coming into the market to buy real estate, mostly I'm talking homeowners right now, not investors, they were looking for inventory. Problem is that because of COVID, a lot of the people who would normally put their properties on the market didn't. And so there was already tight inventory, but then it created this massive shortage of supply because about 40% of those prospective home sellers never actually put their inventory on the market. So now you had 40% less inventory in the spring. Plus you had investors and homeowners coming out to buy with historically low interest rates, and they couldn't find inventory. So whatever was out there was being gobbled up. Multiple offer situations in many markets around the country. And so, there was less than 2 months of supply in so many markets around the country. So we've got this ongoing problem now of tight supply, strong demand. The demand is increasing. We're actually running a deficit of about 400,000 housing units per year short compared to demand. And Freddie recently came out and said, Freddie as in Freddie Mac, they recently came out and said that by the year 2030, so less than 10 years from now, we're going to have, depending on what numbers and reports you read, a housing unit shortage of between 1 million units on the low end and 4 million housing units on the high end. That's in less than 10 years. So the problem we have today, and we've had for many years, is growing even worse. Builders have picked up on this, actually. So you've heard this old model, build to rent. They figured out that there's demand for not only homeowners, but demand for investors to build rental property. So they're getting on that bandwagon. They're putting product out. But the problem is still the same thing. They can't put out enough product fast enough to keep up with investor demand, let alone homeowner demand. So it's an interesting problem, because if you're on one side of the equation, you're doing extremely well. If you're on the other side of the equation, you're suffering because you can't find inventory to buy or invest in or live in. So it's an interesting problem.
So do you think, and what role do you think inflation is potentially playing in like the Fed kind of monetary policy? Because we've seen a lot more dollars pumped into the system, and so prices on all like real assets are going up. So do you think that's going to exasperate this, or not really matter, or what's your take on that?
That's a very interesting question, because last year the monetary policy that was implemented last year because of COVID created 25% of all the currency, the M2 money supply that ever was created in existence here in the US. So just think about that. In 1 year, we created 25% of all currency ever created in the US. You would think that would lead to massive inflation, if not hyperinflation. Could that happen? Possibly. Will it happen? Nobody knows for sure. We actually haven't seen the overall impact of all that currency creation yet. Obviously you see that in certain sectors like education and healthcare. Prices are just continue to go sky high. But we don't see it in a lot of other sectors, especially like, consumables, electronics and whatnot. Will it impact the housing market? Probably at some point. I really don't know. I mean, you listen to guys like Peter Schiff, they say one thing. You listen to guys like, I don't know if Harry Dent's on the same side of the fence, but other economists, and they're saying the opposite. What I am observing is that we haven't seen the impact of all that currency creation, because it's either A, being held on corporate books, B, it's being exported to other countries in exchange for imported goods. So we're exporting our inflation. So the currency is out there. And then there's this other concept where you give people, $1,400 support check or whatever it is, all these support payments, basically stimulus, distributions. People hoard it. They do one of two things. They either pay their bills like they normally would as if they were employed, or they hoard it. They basically put it into savings, and it doesn't get into the economy. Well, if it doesn't go into the economy, there's no velocity of money. And if there's no velocity of capital, you don't see the inflation, because people are choosing not to buy. So the inflation hasn't hit yet. We have still that nominal 2.5%. If you believe what the government tells you, otherwise it's probably more like 3, 4, 5%. But at some point, those chickens will come home to roost. We'll see more inflation.
Yeah, I mean, I've heard a lot of people talk about that. I've heard less people talk about the the shortage. You kind of hear it city by city, or and realtors will say in this market we've a month supply, 2 month supply. Like DC
Yeah.
is typically 1 to 2 months, but I haven't heard it put in terms of like 400,000 now, but maybe a million or a couple million in under a decade. Like, what I can only imagine what that would do to the cost of homes, to rent, price of rents.
Well, right now it's doing three things. It's increasing occupancy rates, it's increasing rental rates, and it's increasing property values, because what we're seeing is price inflation driven by demand, not anything else, right? It's just tight supply, strong demand, and people are buying up what they can because they can afford it, right? The interest rates are so low that they can actually afford to buy property. In fact, in most cases, with few exceptions, but in most cases, housing is more affordable today than it was a year ago. And the reason for that is because interest rates have come down enough that the monthly payment is lower today on that same property that's more expensive than it was a year ago. So even though prices have been going up, people seem to think, well, affordability is going out the window. Well, that might be true in some markets, like more expensive markets, what I call a tier one market, parts of New York, LA, San Francisco. There are corrections going on there too. But the thing is that with interest rates continuing to go down, the monthly payment for that same property is lower than it was a year ago when the property was a little less expensive. So
Yeah, I actually just did a refi on our house, and
yeah,
we refied right before COVID, and it's a VA, so rates are a little bit better than conventional, but I got it down to 2.25, and my first payment, on the amortization table, like, this still shocks me. The principal was higher than the interest on payment on day one. And I remember just a few years ago when, like, the rule of thumb was like 80%, goes to interest, or so it's just amazing how low the rates are going, and that definitely, I think, even with big price jumps, has made it, in terms of, like, the cost of living, even though you're paying more for the house, it actually is cheaper. With that in mind, are you more, from an investor standpoint, are you more bullish on projects that you build to sell, or projects that you build to rent and hold?
Well, both, because whatever you're building is selling. I mean, if it's a good product, it's going to sell quickly. So this is the problem builders are having, and if you look even behind what's happening with builders having a problem having enough inventory to sell to the market, there's also a problem behind that, and that's finding enough land to build, like buildable lots, buildable land that's developed and entitled, that the builders can now acquire. That way they can build product to sell. Otherwise, if they can't get the land, they can't build, and they have nothing to sell, so they're going to go out of business. So there's this strong demand for buildable land, buildable lots, which is also a business that I'm a silent partner in as well. So I can see that trend, and builders are. There was actually an article in the Wall Street Journal just less than 4 weeks ago, just talking about this nationwide problem of lack of buildable land that's ready today to build on for builders. So builders are struggling on both ends. They can't keep enough supply to sell to their customers, and they can't find enough land fast enough to build on. So I'm bullish if you're involved in the business, because the demand is there. From an investment perspective, it's been a great time to be investing in real estate for many years, and it's still a great time now, if not better than any other time, because interest rates are historically low. Demand is through the roof. The numbers still make sense in a lot of markets, especially the 25 markets or so that we deal in, which are for the most part what I call secondary or tier 2 markets, where prices range from $100,000 to maybe $180,000. That's a wide range, but that's a 3-bedroom home, and they rent for anywhere from 0.8% of that purchase price per month to 1% of that purchase price per month. So $150,000 3-bedroom home. It's renting for $1,400 to $1,500 a month. That's pretty normal. That's the sweet spot. That's what we focus on. And so I'm very bullish for that. But if you're an investor and you're not in the market, you're not in the game, you're missing out. You're missing out on the equity growth on that amortized loan. You're missing out on the equity that grows through appreciation over the years. You're missing out on the cash flow from that business. You're missing out on the depreciation that, is a great tax write-off for any passive income you have. If you're not in the game, you're missing out. If you're standing on the sidelines, back to your point on inflation is going to eat away at your savings consistently year over year over time. And so you're losing if you're a saver. But then, the one thing we haven't even talked about is Gen Y and Gen Z. I mean, we've got potentially 72 million Gen Y and 72 million Gen Z that are also coming out of the household. They're coming out of their parents' home, or they're, getting married and they're now going to be buying. Where in the hell are they going to buy? Right? There's huge demand there. So they need to rent or buy somewhere. So you need to get into the game as an investor and have something that you can provide to those guys.
And right now, just with everything and seen, are you more focused on the renting and holding side, or projects that you can flip? I mean, it sounds like you're in the land development deal that I'm sure that's like a get it entitled and flip it. I know you do a lot with buy and hold strategies as well. Like which strategy right now are you most excited about, or do you think it really doesn't matter? Everything's good.
Well, no question about it. Definitely buy and hold, because you don't get any of the benefits of real estate unless you're buying and holding and building a portfolio. You should be adding to your portfolio. If you're just starting out, get that first property, then get that second one as quickly as you can and keep building it, and just focus on one market and buy 3 to 5 houses in that first market, then move to a second market geographically different than the first and add another 3 to 5 properties there. You want to do this as quickly as you can based on your cash and your investable cash and your credit. But definitely bullish on buy and hold. You want to build and need to build a portfolio. And if you haven't been doing this over the years, now's the time. I mean, it's the best time to plant a tree was 10 years ago. The second best time is now. So if you're in the flipping game, first of all, that's not investing. That's a business. You're flipping houses as a transaction, and you're hopefully making chunks of cash, like a profit. But that's very tough to do today, because number one, anybody in that space is chasing after the same limited supply of product. So it's very competitive. And that is really the main problem. So if you can succeed at doing that, great. I don't discourage it, but it's not something I want to do or focus on. I don't like the active parts of real estate, like, buying, fixing, flipping, or rehabbing properties. It's okay. I've done a lot of it, but I'd rather buy income producing rental property that I can hold today and let it grow in value over time and just generate cash flow from it.
So what, I know you mentioned you're in the secondary markets, like 200K and below, typically, like, what areas, what geographic areas? You mentioned 25, but like, what are some examples, just the types of areas that you're looking in, and the specific types of properties that you're trying to get?
Yeah, I'll name some of them. I mean, they're all on our website, but just kind of starting from the north down, there are two pockets within Pennsylvania, the greater Chicago area, not the heart of Chicago, but the outlying cities are surrounding Chicago, which actually, interestingly enough, spills into Indiana, Indianapolis, Indiana, Kansas City, Missouri, Memphis, Tennessee, Jacksonville, Florida, a couple other markets in Southwest Florida, which are very strong in growth.
Collier County down there.
Yeah, Lee County, and just north of it, the 3 counties just north of Lee County, or 2 counties north of Lee County. Those, we're in 5 cities in those markets. It's all new construction. So very strong growth area, lots of jobs, population growth. Those are the key things we look for. Houston, Texas, the Houston Metro, the San Antonio Metro, and then that corridor between San Antonio to Austin is strong growth areas right now. We have more new construction. In fact, I just had a meeting with my builder this morning for a new development that's going to be released in a couple of weeks. So that's going to be pretty exciting. I'm not sure if those are duplexes or single family homes, but it's probably a combination. So San Antonio has been very strong. On and off Oklahoma City. It's hard to get inventory there right now.
Yeah, so I was going to ask, you mentioned duplexes, but are these typically or single families that you're in these markets that you're getting, or duplexes or townhomes?
The bulk of it, I'd say 75 to 80% is single family. And then the remaining 20-25% is made up of duplexes, triplexes, and fourplexes. Like we just opened up a development in the greater Phoenix area where we're building new construction triplexes, which is unusual because they're either duplex or fourplex. But this particular development, because of the lots that are available there, we can build triplexes. So 25% of what we sell are going to be duplex, triplex, fourplex. And in almost every case, it's new construction because you're just not going to find that inventory out there. I mean, anybody who owns a triplex or a fourplex today is doing very, very well. And the odds of them wanting to sell that is very slim, very slim. Why sell it? It's appreciating. Demand is strong. It's always leased. It probably cash flows very well. So unless you're, I don't know. I can't think of why you would want to sell it unless you're desperate for the money, right?
Yeah, and I mean, you can probably refi it, get money out really cheap, not pay
exactly.
the tax, but still use the money. So,
exactly.
Are you finding single families as rentals are doing even better with COVID? Maybe people want more space. They want the yard. They're afraid to be in one building. Maybe some people. So are you seeing even more demand for that type of rental versus,
That's an interesting question. I have not seen that. I have not observed a preference for single family, although I'm sure there's a lot of people out there that would prefer single family over a multi-unit. I'm not sure if people would care if it was a duplex or single family home or even a fourplex because they're spaced out far enough. But I have heard that apartment complexes, like larger, medium to large size, meaning like in the hundreds of units, I've heard people moving out, and the number one reason they're moving out, I shouldn't say number one across the board, but a big reason why a lot of people move out of those larger apartment complexes is because of the fear that has grown in them with COVID. They just don't want to be in a densely populated building with other people, so they've chosen to move out and move into single family homes or duplexes or whatnot somewhere else. So yeah, that does exist.
How do you manage, so many different single families in so many different markets? Because one of the common theme you hear from the guys that are doing multifamily is, management's easier when it's all under one building, and, single family, it's hard to scale, but you certainly seem to have scaled it. How do you tackle the management issue?
Well, there is no management issue. Anybody who says that is somebody who is self-managing, and they'd rather manage one property with multiple units than multiple properties spread out everywhere. So that's the only case that I can think of that would apply. But all of our clients, and my rule of thumb is build a portfolio of 3 to 5 properties in one market, and then move to a second market, 3 to 5 there, and then 3 to 5 in another market, 3 to 5 and 3 to 5 markets. If you're doing that in each of those markets, whether it's 3 or 4 or 5 different markets, you're going to have a professional full service property manager or management company managing those properties for you. So you're not managing them. You might be quote unquote managing the managers, but that's about it. So you let the property managers do their job. They have their different departments and divisions, and they handle all the things from rent collection to repairs. So let the managers do their job, and you don't have to worry about whether they're in one building or they're spread across town. That's what the property manager's job is, and it's that simple. So you just keep an eye on your accounting, stay in touch with your property managers when you need to, and let them do their work. You don't need to have everything in one place.
How do you find the managers in each market? Because I've heard from some investors before, even myself, have had challenges in finding quality managers.
Well, fortunately today we've had, working relationships that have gone on for years. And so we have these working relationships and we know who they are, we know how they work and how they operate. We have feedback, both positive and negative if it exists. So we're just recommending and referring our people to you, the people in our network, those service providers. But in the beginning, and if you're just starting out, you have to do your homework. You have to do your due diligence, contact a bunch of property managers based on referrals and references and testimonials and their reputation online. And you need to figure it out and literally interview these different property management companies to find one that you feel good about and comfortable with. And that's who you end up working with. So if you're just starting out, it's legwork. For us, we've already got these established relationships. So we're just referring them to our clients that work with us. But,
yeah, I mean, I think I agree with everything you said there. You got to do your homework, and a little bit of work up front is going to save you a lot of time and money and headache and stress and all that down the road.
Yeah.
Anything else you think, just advice to people starting out, in this market investing?
Yeah, well, my first piece of advice would be this: the best investment you can make that pays the highest returns is the investment you make in yourself. Invest in what's between your ears. Constantly educate yourself, listen to podcasts. There's a lot of good content online, whether it be in video format or reading. Books are the cheapest form of education, 10, 20 bucks a book. There's all kinds of books you could read out there that will educate you on anything and everything to do with real estate, the economy, finance, whatever, personal development, but make that investment in yourself because, that saying, the more you learn, the more you earn. There's a lot of truth in that. The more you learn, the more you earn. And most of the successful people, if not all the successful people that I know and work with, constantly read. They constantly educate themselves. And number two is take action, because you could become the most knowledgeable person on a subject in the world, but if you don't take action, if you don't actually put the rubber to the road and start moving forward, you're not going to get anywhere. So make sure that you take action, and part of that is actually building the right team of people around you. Whether it's an acquisitions person or an acquisitions company, your lenders, your property managers, your asset protection attorney, your tax advisor. You need the team around you, right? So you build that team to go on the ride, the journey with you. But if you don't take action, nothing's going to happen. So you have to do both: educate yourself and take action. And I guarantee you, if you do both of those, odds are 99.9% of the time you're going to be successful. You're going to look back 5-10 years from now and say, holy crap, wow, I've accomplished a lot. So.
Yeah, you don't actually learn it fully until you take action too. That's the other part of it. Like, you can
100%. Yeah.
do all the reading in the world, but at some point you have to learn by doing.
Yeah. You've got the education component, knowledge, then you have the experience. And then as you grow with both of those things, you gain wisdom. So you have to have both of those pieces of the puzzle to ultimately gain wisdom and have true success.
Well, thank you for being a two-time guest on the show and giving us this amazing update on what's been going on this last year and how you've reacted to COVID and what you think is ahead. I look forward to following up with you for a third time down the road to see how this all plays out. Before we sign off, if people want to connect with you or learn more about what you're doing, what are some of the ways they can do that?
Yeah, I appreciate you asking, and thanks for for the interview today and everything we talked about, Dan. I'm sure your listeners got something out of this, but I appreciate the question. So really, the best way to connect with me and my team is from our two websites. The main website, which we've been talking about, is Norada Real Estate, Norada, noradarealestate.com. And the sister website is passiverealestateinvesting.com. And that's the home of our podcast at passiverealestateinvesting.com. And that's it. All our contact info is there.
All right, and we'll make sure to put that in the show notes and the description on YouTube and all of that. And thank you for being on the show, and to all the listeners and viewers out there, thanks for tuning in. We'll see you next time.
Thanks, Dan.
Thank you for tuning in to this episode of the HyperFast Show. Subscribe to us if you want to make sure you get the latest and greatest HyperFast shows. And remember, we love reviews. Reviews help us bring better and better guests and improve our shows. So give us the good, the bad, and the ugly. We hope you enjoyed the show, and we will see you next time.
Hey guys, thanks for sticking around to the end. I hope you enjoyed that video, and if you want to see more, click right here. And if you want 100 real estate tips from my best-selling book, click right here to download them instantly. And if you're new to this channel, click below to subscribe and turn on post notifications so you don't miss out. And leave some comments about what you think on the videos.